Let me say this slowly and clearly. If you're on Social Security now or you expect to be in the next few years, what's coming in 2026 is not as simple as good news. Yes, there is a benefit increase projected. That part is real. But the part that matters most is not the headline number. It's what actually lands in your bank account after everything else adjusts around it. I've been watching how early policy language is forming, how inflation data is being interpreted, and how officials are talking about this increase without fully explaining the side effects. When that happens, experience tells me there is usually a second sentence that never makes the headline. A formula change. A timing issue. A premium adjustment. A threshold that quietly moves. That second sentence is where seniors either gain stability or quietly lose it without realizing until months later. If you're interested in this topic, hit the like button, subscribe, and type "interested" in the comments. And I will give you a heart. I've spoken with retirees who celebrated an increase only to find their Medicare premium went up, or their prescription costs rose, or a tax threshold changed and reduced their net benefit. Not because they made a mistake, because they were never warned to look beyond the headline. Before anyone assumes 2026 means breathing room, the full picture matters. And that's what we're going to walk through calmly and clearly. If you're watching from the United States, Canada, the UK, or somewhere else, drop your location in the comments. It helps me understand who this information is reaching, and it reminds people they're not alone in these conversations. Now let's talk about what this increase really is. When you hear Social Security increase, what's really being discussed is the cost of living adjustment, often called COLA. COLA is tied to inflation data. The idea is simple. When prices rise, benefits rise to help keep purchasing power stable. On paper, that sounds fair. In practice, the formula does not always reflect how seniors actually spend money. The inflation measure tracks a broad basket of consumer goods. That basket includes things like transportation, entertainment, apparel, and services that may not reflect the real spending patterns of retirees. The government uses a specific index called the Consumer Price Index for urban wage earners and clerical workers, or CPIW. This index was designed to measure spending habits of working-age adults in urban areas, not retired individuals living on fixed incomes. Seniors tend to spend more on medical care, prescription drugs, insurance premiums, utilities, housing, food. Those categories often rise faster than the general inflation measure used in the formula. Healthcare costs, in particular, have consistently outpaced overall inflation for decades. A senior paying hundreds of dollars more each year for medications or supplemental insurance feels that gap acutely. Meanwhile, categories like electronics or clothing, which tend to see stable or falling prices, carry significant weight in the index but represent a smaller portion of most retirees' actual budgets. That's why many seniors say, "My check went up, but I'm still falling behind." They're not imagining it. The increase exists, but the real-world costs around it move differently. A 3% COLA means little when your Medicare Part B premium rises, your prescription costs increase, and your grocery bill climbs by more than the overall adjustment covers. The math simply does not balance out the way the formula suggests it should. Some economists and advocacy groups have pushed for an alternative measure called the CPIE, which specifically tracks spending patterns among elderly consumers. Studies using this index suggest seniors experience inflation at a higher rate than the general population, sometimes by 0.5 percentage point or more annually. Over time, that difference compounds significantly. This isn't a flaw unique to 2026. It's how the system has always worked. The formula is consistent, but life isn't. Congress established the current methodology decades ago, and changing it would require legislative action. Various proposals have surfaced over the years, but none have gained enough traction to become law. So when officials announce a projected increase, it tells you what the formula produced. It does not tell you what your personal budget will feel. Your individual circumstances, your health needs, your location, and your housing situation all shape whether that percentage translates into real financial relief or merely softens a larger blow. That's the first gap people need to understand. Let me give you a real-world example. A retiree I spoke with last year, we'll call her Linda, saw her monthly benefit increase. She felt relief. She thought she finally had a little breathing room. Within months, her Medicare premium adjusted upward. Her prescription plan changed pricing tiers. Grocery prices climbed faster than expected. Utilities nudged higher. By the end of the year, the increase was gone. Linda didn't miscalculate. She didn't overspend. She simply experienced how multiple systems adjust at the same time. Her situation is not unusual. Financial advisors who work with retirees see this pattern repeat every single year. The The check grows, but the obligations grow alongside it. Social Security does not operate in isolation. When benefits rise, Medicare premiums often rise. Insurance plans update pricing. State and local costs continue climbing. Some income thresholds shift. Property taxes creep upward. Supplemental coverage adjusts its rates. Even small changes across multiple categories add up quickly when you're working with a fixed income that leaves little margin for error. Consider what happens in sequence. The Social Security Administration announces the COLA in October. Medicare announces Part B premium changes around the same time. Insurance companies finalize their rates for the coming year. Utility companies file for adjustments. Landlords review lease terms. All of these decisions happen independently, but their effects land on the same household budget within a matter of weeks. For someone like Linda, there's no single villain. No one entity took her increase away. Instead, a dozen small adjustments, each reasonable on its own, combined to erase whatever ground she thought she had gained. The net result can feel like running in place. Or worse, like slowly falling behind despite doing everything right. That's why it's important to separate two different questions. Did benefits increase? Yes. Did your financial pressure ease? Not always. Understanding this distinction matters because it changes how you plan. If you assume the COLA will create breathing room, you may be caught off guard. If you recognize that other costs will adjust in tandem, you can prepare differently. You can budget for the increase and the offsets at the same time. That difference is where confusion and frustration usually begin. It's also where realistic planning should start. Another part that rarely gets explained is timing. Even after an increase is approved, when and how it shows up can affect how useful it feels. Some adjustments appear at the start of the year. Some interact with Medicare premium changes that hit at the same time. Some costs adjust earlier or later. The announcement of a COLA comes in October, but the new benefit amount doesn't arrive until January. That's a 3-month gap where you know what's coming but can't access it yet. Meanwhile, other changes don't wait. Prescription drug plans often update their formularies and pricing tiers at the start of the new plan year. Insurance companies send premium notices in the fall. Utility rate increases can take effect whenever regulators approve them. Landlords may adjust rent at lease renewal, which could fall anywhere on the calendar. For seniors living on fixed income, timing matters. You budget months ahead. You don't have the luxury of waiting and seeing. Every dollar has a destination before it arrives. When one piece of the puzzle shifts without warning, the entire month can feel off balance. If premiums rise before your benefit increase appears, you may feel squeezed even if relief comes later. A retiree facing higher Medicare costs in December while waiting for a January COLA may need to dip into savings or cut back on essentials just to bridge the gap. That short-term strain is real, even if the numbers eventually balance out. The same issue applies to tax withholding changes, supplemental insurance adjustments, and any automatic payments tied to your benefit. Each system operates on its own schedule. None of them coordinate with one another. The burden of tracking these overlapping timelines falls entirely on the individual. That doesn't mean the increase is wrong. It means the sequence matters. A benefit that arrives after a cost has already hit feels different than one that arrives before. The dollar amount may be identical, but the lived experience is not. Planning requires predictability. Seniors understand this better than anyone. They've spent decades managing households, paying bills on time, and stretching dollars when needed. What they're asking for isn't special treatment. It's simply enough information delivered early enough to make sound decisions. When the timing of adjustments remains unclear or fragmented, even a generous increase can feel like it showed up late to a problem that already did its damage. Two people can hear the same announcement and experience completely different results. Here's why. If you claimed benefits early, your increase applies to a different base amount than someone who delayed retirement. A person who filed at 62 locked in a permanently reduced benefit. A person who waited until 70 built up delayed retirement credits. When the same percentage increase applies to both, the dollar amounts diverge significantly. A 2.5% increase on $1,400 looks very different than 2.5% on $2,200. The gap that existed before the COLA remains after it, and in absolute terms, it actually widens. If you're still working part-time, earnings rules interact with your benefit. Before reaching full retirement age, Social Security reduces benefits if your earnings exceed a certain threshold. That reduction is temporary, and the withheld amount gets factored back in later, but the immediate effect can offset part or all of the COLA you expected to see. The increase is still yours on paper, but it may not show up in your monthly deposit the way you anticipated. If you're widowed, divorced, or receiving survivor benefits, the math changes. Survivor benefits are calculated based on your spouse's earnings record, not yours. Divorced spouse benefits come with their own eligibility rules. Each category follows a distinct formula, and the COLA applies differently depending on which benefit type you receive. Two neighbors collecting Social Security may see very different outcomes from the same announcement. If you're receiving assistance programs tied to income thresholds, a small increase could affect eligibility. Programs like Medicaid, SNAP, or low-income housing assistance use income limits to determine who qualifies. A modest bump in Social Security might push someone just over a threshold, reducing or eliminating benefits that were worth more than the COLA itself. This is sometimes called the benefits cliff, and it catches people off guard every year. None of this is unfair. It's structural. The system wasn't designed with malice. It was built to apply consistent rules across millions of people with different circumstances. But consistency in rules does not mean consistency in outcomes. Your starting point, your work history, your family status, and your other income sources all shape what any given adjustment actually means for you. But it means blanket headlines don't tell your personal story. A news report announcing a 2.5% increase describes the formula's output. It doesn't describe what happens in your checking account. It can't account for your Medicare premium tier, your prescription costs, your housing situation, or whether you're still earning income on the side. Relief is not automatic. It depends on how your situation interacts with the system. That's why personalized planning matters more than national averages. The only number that truly counts is the one that lands in your account after all the adjustments, deductions, and interactions have played out. This is one of the biggest factors seniors feel directly. Medicare Part B premiums are commonly deducted directly from Social Security checks. Most beneficiaries never see their full benefit amount. What arrives in the bank account is what remains after Medicare takes its share. That automatic deduction makes the interaction between these two systems immediate and unavoidable. If Medicare premiums rise faster than the benefit increase, the net change may feel smaller than expected. In some years, the Part B increase has consumed nearly the entire COLA for certain beneficiaries. You might hear that benefits rose by 2.5%, but if premiums climbed at a similar rate or higher, your actual deposit barely changes. The math isn't wrong. It's just incomplete without both numbers on the table. There's a protection built into the system called hold harmless, which prevents Part B premium increases from reducing the Social Security benefits of most current enrollees. But this provision has limits. It doesn't apply to everyone, particularly higher-income beneficiaries or those newly enrolled in Medicare. And it only protects against nominal reductions, not against the feeling of treading water when your increase and your premium rise in lockstep. Supplemental plans can also adjust. Many seniors carry Medigap policies or Medicare Advantage plans to cover costs that original Medicare doesn't handle. These private plans set their own premiums, and those premiums tend to rise annually. A COLA might cover your Part B increase but leave nothing to absorb the bump in your supplemental coverage. Once again, the benefit grew but the net effect shrank. Prescription drug costs can change tier structures. Part D plans and Medicare Advantage drug coverage use formularies that categorize medications by cost tier. A drug that sat on Tier 2 last year might move to Tier 3 this year. The plan didn't necessarily get worse. The pricing structure simply shifted. But for someone taking that medication daily, the out-of-pocket cost just climbed regardless of what happened to their Social Security check. None of this means the increase disappeared. It means other systems adjusted alongside it. Social Security, Medicare, and private insurers each make their own calculations. They don't coordinate timing or magnitude. They simply publish their changes, and beneficiaries absorb the combined effect all at once. Understanding this interaction is essential for realistic expectations. If you only track the COLA, you're watching one piece of a larger puzzle. The clearer picture emerges when you line up all the adjustments together, see where they overlap, and calculate what actually remains. That's the number that matters for your budget. Not the headline. The net. Another quiet factor is income thresholds. When benefits rise, some seniors may cross technical income lines that affect tax treatment, assistance eligibility, premium adjustments. These thresholds don't adjust automatically with inflation. Many were set years ago and haven't moved since. So while your benefit inches upward each year, the lines that determine how that benefit gets treated often stay frozen in place. You may not feel richer, but the system may treat you differently on paper. Take taxation. Social Security benefits can become partially taxable once your combined income exceeds certain limits. For individual filers, the threshold starts at $25,000. For married couples filing jointly, it begins at $32,000. These figures were established in 1984 and have never been updated. 4 decades of inflation have pushed more and more retirees above those lines, even when their real purchasing power hasn't changed. A modest COLA can tip someone from owing nothing to owing something, not because they're living better but because the math crossed an invisible boundary. Assistance eligibility works similarly. Programs like Medicaid, SNAP, the low-income subsidy for Part D, and various state-level benefits use income limits to determine who qualifies. A small increase in Social Security might push someone a few dollars over the cutoff, resulting in reduced benefits or complete disqualification. The loss often exceeds what the COLA added. This is the benefits cliff in action, and it penalizes people for gains they can barely perceive. Premium adjustments follow the same pattern. Medicare Part B and Part D both use income-related monthly adjustment amounts, known as IRMAA. Higher earners pay higher premiums. The brackets that determine these surcharges do adjust for inflation, but they use income data from 2 years prior. A spike in income from 2024, perhaps from a one-time withdrawal or required minimum distribution, could trigger higher premiums in 2026. The COLA you receive this year might be offset by a premium increase rooted in something that happened 2 years ago. That's why reading notices carefully matters. Not with panic. With attention. The Social Security Administration, Medicare, and other agencies send notices throughout the year. These documents explain what's changing when it takes effect, and what your new amounts will be. They're not always easy to read, but they contain the details you need to plan accurately. Ignoring them or skimming too quickly can leave you surprised when the numbers don't match your expectations. Something looks off, you have the right to ask questions. Contact the agency directly. Request clarification. Make sure you understand how each threshold applies to your specific situation. Being informed isn't about anxiety. It's about staying one step ahead of a system that won't slow down to explain itself. You cannot control inflation formulas. You cannot control Medicare pricing. But you can control awareness. The systems that determine your benefits operate on their own schedules, following rules set by legislation, regulation, and actuarial calculations. You have no vote in the formula. You have no say in how Medicare sets its premiums. But you do have control over how prepared you are when those decisions land on your doorstep. Here's what helps. Review your benefit letters carefully each year. The Social Security Administration sends a notice each December detailing your new benefit amount for the coming year. This letter shows your gross benefit, your Medicare deduction, and your net payment. Read it line by line. Compare it to last year. Understand where the numbers changed and why. Track how Medicare premiums interact with your check. Don't assume your COLA translates directly into more money in your account. Look at the Part B premium deduction. If it rose alongside your benefit, calculate the net difference. That's the number your budget actually has to work with. Watch how prescription plans change annually. Every fall, Medicare Part D plans publish their formularies and pricing for the next year. Your current medications might move to a different tier. Your copays might shift. A plan that worked well this year might cost more next year. Review the annual notice of change that your plan sends, and compare options during open enrollment if something looks off. Keep records of communications with Social Security. Save your letters. Note the dates of phone calls. Write down the names of representatives you speak with and what they told you. If a dispute arises later, documentation protects you. Memory fades. Paper doesn't. Ask questions early, not after something feels wrong. If a number looks unfamiliar or a deduction seems higher than expected, contact the Social Security Administration or Medicare right away. Waiting allows confusion to compound. Early questions lead to faster answers and fewer surprises. Knowledge prevents surprises. The goal isn't to become an expert in federal benefit law. The goal is to understand your own situation clearly enough that nothing catches you off guard. You've earned these benefits. You've paid into the system for decades. Taking the time to understand how it works isn't optional. It's part of protecting what's yours. The seniors who navigate these changes most smoothly aren't the ones with the highest benefits. They're the ones who stay informed, ask questions, and treat each annual adjustment as something worth understanding rather than something to passively accept. Awareness won't change the formula, but it will change how the formula affects you. Many seniors continue working part-time. Some do it because they want to stay active and engaged. Others do it because they need the income. Either way, working while collecting Social Security is common, and it comes with rules that affect how much you actually receive. If you collect benefits before full retirement age, earnings limits apply. For 2025, the earnings limit is $23,400. Social Security withholds $1 for every $2 earned above that limit. That means if you earn $25,400, you've exceeded the limit by $2,000, and Social Security will withhold $1,000 from your benefits. The withholding isn't a penalty or a tax. It's a temporary reduction based on your earnings. In the year you reach full retirement age, the limit is higher, about $62,160, and the withholding rate changes to $1 for every $3 above the limit. This more generous threshold applies only to earnings in the months before you hit full retirement age. Once you cross that birthday, the earnings test no longer applies for the rest of the year. After full retirement age, there is no earnings limit. You can earn as much as you want without any reduction in benefits. This is one reason some financial advisors suggest delaying benefits if you plan to keep working. But for those who claimed early and still work, understanding the limits is essential. Only wages and self-employment income count. Pensions, investments, interest, and government benefits do not count toward the earnings test. If you're drawing from a 401k, receiving dividends, or collecting a pension from a former employer, none of that affects your Social Security benefits under the earnings test. The rule focuses narrowly on active work income. If you exceed the limit, Social Security withholds benefits early in the year to offset it. Rather than reducing each monthly check slightly, the agency typically withholds entire checks at the start of the year until the required amount is recovered. That can create a jarring gap in income for the first few months, even if benefits resume later. Planning for this possibility matters, especially if you rely on that check for regular expenses. Overpayments can become complicated if estimates are wrong. When you're working and collecting benefits, Social Security asks you to estimate your annual earnings. If your actual earnings come in higher than expected, you may receive more benefits than you were entitled to. The agency will eventually catch the discrepancy and seek repayment, sometimes months or even years later. These notices can be confusing and stressful, particularly if the overpayment amount is significant. The good news is that withheld benefits are not lost forever. When you reach full retirement age, benefits are recalculated to account for months benefits were withheld. The Social Security Administration adjusts your monthly amount upward to credit you for the benefits you didn't receive during your working years. It's not a lump sum payment, but it does increase your ongoing benefit for the rest of your life. Still, reporting earnings accurately matters to avoid overpayment issues. If your income changes during the year, let Social Security know as soon as possible. Update your estimate rather than waiting until tax season. Accurate reporting prevents surprises, reduces the risk of repayment demands, and keeps your records clean. Working while collecting benefits is entirely allowed. It just requires attention to the rules, honest reporting, and a clear understanding of how the earnings test affects your monthly check. If you receive SSDI, different earnings limits apply under substantial gainful activity rules. Social Security disability insurance operates under a different framework than retirement benefits. The program is designed for people who cannot engage in substantial work due to a medical condition. Because of that foundation, the rules around working while receiving SSDI focus on whether your earnings indicate an ability to support yourself through employment. For 2025, $1,620 per month generally, $2,700 per month if blind. These figures represent the substantial gainful activity threshold, often called SGA. If your countable earnings exceed this amount, Social Security may determine that you're capable of substantial work and no longer eligible for disability benefits. The stakes are higher than with retirement benefits, where exceeding an earnings limit simply triggers a temporary withholding. With SSDI, crossing the SGA threshold can lead to termination of benefits entirely. However, the process isn't immediate. Social Security provides a trial work period that allows you to test your ability to work without losing benefits right away. During this period, you can earn any amount for up to 9 months within a rolling 60-month window. These don't have to be consecutive months. Any month in which you earn more than a set amount, $1,110 in 2025, counts as a trial work month. Once you've used all 9 months, Social Security evaluates whether your earnings consistently exceed the SGA limit. After the trial work period ends, you enter a 36-month extended period of eligibility. During this window, you can still receive benefits for any month your earnings fall below the SGA threshold. If your earnings exceed it, benefits stop for that month but can resume if your income drops again. This provides some flexibility as you navigate the transition back to work. There are also deductions that can reduce your countable earnings. Impairment-related work expenses such as medications, specialized transportation, or assistive devices you need in order to work, can be subtracted from your gross earnings before Social Security applies the SGA test. These deductions can make a meaningful difference for someone hovering near the threshold. Different rules apply here and professional guidance may help. The interaction between SSDI work incentives, trial periods, and countable income is more complex than the retirement earnings test. Mistakes can be costly, and the consequences of misunderstanding the rules can include losing benefits you still need. If you're receiving SSDI and considering work, or already working and unsure how it affects your benefits, speaking with a benefits counselor or disability rights organization can provide clarity. Many communities offer free or low-cost assistance through programs like Work Incentives Planning and Assistance, known as WIPA. These counselors specialize in helping disability beneficiaries understand how employment affects their benefits and how to use available work incentives without jeopardizing their financial stability. The goal isn't to discourage work. It's to make sure any step you take is informed, intentional, and safe for your long-term security. Social Security was designed to provide stability, not luxury. The program was never meant to replace your full working income. It was built as a foundation, a floor to stand on while other resources filled in the gaps. For some retirees, those other resources exist. Pensions, savings, investments, and family support round out the picture. For others, Social Security is nearly everything. Either way, the system's purpose remains the same: provide a reliable, predictable source of income that arrives every month without fail. Predictability matters. When you're living on a fixed income, certainty is currency. You need to know what's coming in and when. You need to trust that the check will arrive, that the amount will be what you expected, and that you can plan your month around it. That predictability is what allows seniors to budget, to manage medications, to keep the lights on, and to maintain some measure of independence. When increases are announced without explaining offsets, that predictability weakens. A headline that says benefits are rising by 2.5% tells only part of the story. If Medicare premiums rise at the same time, if prescription plans shift their pricing, if supplemental insurance adjusts its rates, the net effect could be far smaller than the announcement suggested. Without that context, seniors are left to discover the gap on their own, often when the first check of the new year arrives and doesn't match expectations. This isn't about being cynical. It's about being complete. An honest conversation about Social Security adjustments would include both the increase and the likely offsets. It would acknowledge that the COLA is a formula-driven output, not a guarantee of improved purchasing power. It would respect seniors enough to share the full picture rather than a simplified talking point. Seniors don't need slogans. They need understanding. They need explanations that treat them as capable of handling complexity. They've managed households, raised families, navigated careers, and paid into this system for decades. They're not asking for special treatment or unrealistic promises. They're asking for honesty, clarity, and enough information to make sound decisions. That's why slowing down and looking beyond the headline protects you. The announcement is just the starting point. What matters is what you do next. Read the letters. Review the notices. Compare the numbers. Understand how each piece interacts with the others. The few hours you spend doing this can prevent months of confusion and frustration. The system won't slow down to explain itself. It will keep sending adjustments, premiums, and notices on its own schedule. Your job is to stay informed, ask questions, and make decisions based on your reality, not the headline. That's where real stability comes from. Not from the formula. From your own preparation. An increase is not abstract. It's groceries. It's prescriptions. It's peace of mind. It's dignity. Even a small improvement can ease stress. But disappointment comes when expectations aren't realistic. Being cautious doesn't mean being ungrateful. It means being wise. Here's the honest summary. The 2026 increase is real. So are the pressures around it. Healthcare costs, housing, utilities, food. Those don't pause for policy adjustments. Staying informed matters more than celebrating headlines. Understanding how COLA, Medicare deductions, earnings rules, and thresholds interact protects you. If your last increase felt helpful or if it disappeared quickly, share your experience in the comments. These conversations help others feel less alone and more prepared. If this breakdown helped you understand what really matters behind the headlines, subscribe so you don't miss updates that actually matter. Staying informed is one of the best protections you have.